In this bonus episode, we are joined again by one of our favorite sources of insights on markets today, Dr. David Kelly, Chief Global Strategist at JP Morgan Asset Management, fellow Irish person and fellow runner. Tune in to hear our live conversation from January 26th, in which we race through topics as diverse as inflation, interest rates, social media, US elections, equity market valuations, and investor sentiment, at a pace more akin to a brisk 5K than a marathon. Please enjoy my conversation with Dr. David Kelly. Welcome, David. Never a dull moment and a bad time to have you on the tee, it seems. But let's just kick off with one of the first questions I wanted to ask you about, which is around this enduring resilience. So I think you've always been probably on the more optimistic end of the strategists looking at recession indicators, etc. But if you were to say why you've been 34 years doing this, at least, how do you attribute this economy's enduring resilience?
Well, I think it's really centered around consumers, because we went into last year and we realized that consumers had mostly burned through the money that they'd saved during the pandemic. We could see the credit card debt was rising. Consumer confidence was very low. People were talking about a recession. And it would make perfect sense, I suppose, for rational consumers to pull back, except they didn't. And I think, over the years, I have come to appreciate and respect the ability of American consumers to spend money they don't have on stuff they don't need. And I think they proved that again in 2023. And I think this is really one of the keys. There are a few keys to understanding the behavior of the American economy, but one of them is that we really do, or at least a subset of American consumers, spend addictively. I mean, they literally find themselves buying all sorts of stuff that they really don't need, with not much regard to the personal financial consequences of doing so. But collectively, that leads to consumer spending, which is much stronger than you would think. And collectively, of course, it then generates the income and the growth, which actually feeds the spending. By all spending beyond our means, we collectively create the means by which we spend. And I think that has really been the biggest surprise, is the extent to which that happened in 2023. And then the second thing that I think was a bit of a surprise is that, given significantly higher interest rates and given the mini banking crisis earlier on in the year, investment spending didn't boom, but it didn't collapse either. And how did investment spending stay so resilient? I think part of that is the green transition and the CHIPS Act fostering more spending by manufacturing on manufacturing facilities. And then part of it's just a labor shortage and the potential in AI and the excitement around AI. And nobody wants to fall behind in terms of investing in new technology that would help their company grow. I think those two things it's not so much about the resilience of the economy, it's about the resilience of consumers and the stability of investment spending that really gave us this result.
Well, just to pick up on one of those points, if this is money they don't have, now maybe if it's COVID money, they got it once and they'll never get it again, but so it was a one-off expenditure. But do you see signs of credit card debt perhaps rising, the consumer credit rising, and delinquencies starting to kind of raise their head?
Only to some extent. You can look at these charts and say, this is the worst since before the pandemic. But before the pandemic, American consumer balance sheets were actually in excellent shape. What happened is, if you go back 15 years ago, to the great financial crisis, then they certainly weren't in good shape. Consumers borrowed a huge amount of money going into the financial crisis, and the debt service ratio, or the percentage of income that you needed just to service your debt, was very high. And then it collapsed in the years after the great financial crisis because banks, frankly, wouldn't lend to people. And so on the eve of the pandemic, consumer balance sheets were in excellent shape. Debt service was very low relative to income. Then it got better again because people didn't spend during the pandemic. It's gotten worse again. So we're back to where we were pre-pandemic. But that's by no means a limit. We can certainly see further increases in credit card debt, which is, after all, only about 10% of consumer debt is credit card debt. We can certainly see those further increases, further delinquencies, before we reach any point at which it is really slowing the economy down.
And I suppose it'd be good to just give a snapshot of your view on inflation today. And this ties a little bit to the next point around potential for negative surprise there. We seem to be sort of settling into this soft landing narrative as almost a conclusion that inflation has been dealt with and that the Fed can, in its data dependency, ease off a little. What are your thoughts on that coming down? I think is the Eiffel Tower we had for the image for inflation's rise and fall. Yeah.
Very, very proud of that, because we are now 2/3 of the way down the Eiffel Tower on the other side. We saw the inflation rate go from 2 all the way up to 9, and now it's back down to 3. So we're almost there. We need to get it back down to 2, but we're almost there. And I think that's going to happen over the course of this year. One of the big debates at the start of this year is, is inflation going to continue to slide or is it sticky? And there's a lot of people in the sticky camp. Oh, well, the last mile is going to be the hardest. I'm not really in that camp. I mean, I do think that mathematically the inflation rate has to come down more slowly than it has come down to this point. But if you dive into the details of the US inflation rate, something rather startling jumps out. First of all, if you look at overall inflation, of the 3.3% CPI number year over year that we've got for December, 2.1 percentage points, 2.1 percentage points are coming just from shelter, which is rent and owner's equivalent rent. And they're showing a 6.5% year over year increase. But that 6.5% year over year increase is really based on a lagged survey of rents relative to the last time they checked with you. If you actually look at market rents in terms of rents being negotiated, they've stopped rising or are rising at a very slow pace. And so we know that the year over year numbers on rent growth, it's going to continue to fall. It has already begun to fall, but it's going to fall all the way through 2024. That's going to bring down also the increase in owner's equivalent rent. So right there, the single biggest thing that's pushing up inflation overall or holding up inflation overall is set to slide further. And then we don't really have a big problem with food or energy inflation. And frankly, the global economy is chugging along. It's not booming and it's not going to cause great inflation in commodities on its own or even on core goods. I know we've got some issues on the Panama Canal and perhaps even a worse issue in the Red Sea. But these things are not enough on their own to cause significant goods inflation. So that leaves us with what Chairman Powell often talks about, which is core services, ex housing. And if you look at that big group of services, the Fed seems to think that that is really caused by, that inflation comes from a tight labor market and then it's been going up. But actually, wage growth has been coming down pretty steadily. But also, if you look at that category, the big thing that jumps out at you is it's not about wages. It's not even broad-based. It's all about auto insurance. Auto insurance in the last year is up by 20.2%, according to the CPI. Now, it's got a 2.8% weight in the CPI, but that means that it's about 0.6% of that 3.3 is just coming from auto insurance. And that's also going to fade. We know that the price of new vehicles has stopped rising. I just saw a forecast from JD Power, which said that in January, it looks like the price of new vehicles sold is going to be 3.5% lower than it was 12 months earlier. And that's just continuing a trend. We're seeing that in the used car prices too. So if the vehicles are stopping going up in price, and we know that the rate of inflation in repair has gone down too, insurance has got to crack. And it's not going to be 20% a year from now. And if it's 10% a year from now, and I take that 0.6, take it down to 0.3. So these are the two big columns that have been holding up inflation, and they're crumbling. And that is why I'm so convinced that barring some other shock, inflation's not going to rise. It's not going to stick. It's going to fold. And I think inflation is going to come down all the way down to 2% over the course of 2024.
Well, that confidence around auto insurance spoken from a man whose children are no longer the teenage years, I think, which is what the rest of us have to suffer through. We have one question in the chat as asked about cumulative price change since 2020. Basically, the cumulative cost of living increase 20%. He is more looking at that than the year on year. We're still digesting this very high single digit inflation. Yep. And do not think, even though you said it's folding, does it need to be more substantial with cost of living to adjust?
So the real thing is, what are you looking for as an investor and what are you looking for as a consumer or voter or household? So the bad news is energy prices can go up and down. So, okay, we got up to $5 a gallon. Now we're down to $3.10 a gallon, according to AAA, is the price of regular leaded gasoline around the country. So that can have a swing. But things like food prices, the price of a chocolate bar. So somebody showing the Snickers index in terms of their view of the cost of living. The cost of living has gone up and it won't come down barring a depression. And that may account for still very gloomy consumers. Now, we're seeing some improvement in sentiment, but the consumers are pretty gloomy. And they're right to be gloomy because they are paying higher prices. And we can get into why they're paying higher prices perhaps later, but that's what's there. But for financial markets, if you buy a financial asset today, the return that you expect on that financial asset or you want on that financial asset should be based on what the inflation rate is going to be from the day you buy it going forward. So you got to be forward looking when it comes to inflation. And so that's why I think the fact that inflation is likely to fall from 3% to 2% and really stay at sort of that close to 2% level going forward, I think that's more relevant for interest rates, it's more relevant for appropriate stock prices, it's more relevant for investment decisions than the pain that people have suffered over the last 3 years as prices have risen. And there's no doubt about that people feel very grumpy about it, but it just isn't the right thing to look at in terms of investing from here.
Perfect segue into two areas. We can go two directions, but let's go one place and then another. Let's talk about that vibe session a little bit, why people have been feeling so grumpy, and also why are they paying higher prices? Is this just companies keeping their margins fat, exploiting pricing power, some sticky perhaps inputs that can't move? We talk about that, and then we'll talk about the election, because clearly that vibe session and the concept of Biden inflation is going to be a big election issue, and the narrative around that.
Okay, first of all, let's talk about what caused the inflation. It's very clear what caused the inflation. Part of it was the supply chain issues caused by the pandemic. Part of it was the supply chain effects of Vladimir Putin's horrendous invasion of Ukraine. But the other part of it was all the fiscal stimulus put in by both the Trump and the Biden administrations. They're both to blame. We spent way more money during the pandemic and immediately after the pandemic on cash being given to low and middle income households than was necessary. And this was not just about Biden. It was very much about Trump. It was that both parties deserve equal blame for this, because when the pandemic hit, it was right to try to help people whose livelihood was reduced by the pandemic. It was not appropriate to send checks to my sons, both of whom were gainfully employed and actually busier during the pandemic than they were before the pandemic. But it was just sort of blank, here's free money, because it was popular. And that's, of course, what caused it. If you give rich people money, they may invest it. If you give low and middle income people money, they will spend it on stuff. And if supply chain issues means the stuff's not there, you end up with inflation. It is pure fiscal policy. It's not about party. Both parties have equal blame in this because they both supported multiple stimulus packages, which caused this inflation. That's what caused it. When you take that fiscal stimulus away, the inflation goes away. That's exactly what happened. That's exactly what happened. It's not monetary policy, but it's about a supply-demand mismatch. That's what caused it. In terms of attitudes, one of the really interesting things that we've been looking at, and I've been forecasting American consumer sentiment for many, many years, but consumer sentiment was extremely low in November relative to what the fundamentals said. I mean, if you look at it, even today, we've got a 3.7% unemployment rate, a 3.3% inflation rate. You add those together, you're at 7%. That's better than it's been more than 80% of the time over the last 46 years. Generally, you've got a higher combination of inflation and unemployment than you have right now. But yet, in November, consumer sentiment was worse than it's been more than 90% of the time. So what we had was a top quintile economy with a bottom decile attitude. Now, let me talk about why I think that is. I think part of it is the very point that your earlier caller mentioned, which is people think about not about inflation, but about high prices. And so if the prices are up and they're not going down, and people ask them how the economy is going, it's terrible. Look at the price of this. That's part of it. But I think it's also political division in this country. And the fact that people get their information from cable networks on both sides, on the left or on the right. And the only thing these networks have in common is they tell you need to be very scared and very angry. And then they get a social media feed, which is increasingly and nefariously deliberately designed to inflame the very things that they've been interested in the past. So people who generally lean right get a very right-wing feed. People who generally lean left get a very left-wing feed. And social media is just making people grumpier and grumpier and scared, more and more scared. And that's what I think is really undermining attitudes also. Now, there is also inequality, which I think is contributing to it. But I think a lot of it has to do with how we consume information. And that's why we are grumpy. The one silver lining here is I do see some break in the ice here. I think the fact that gasoline prices have been down, the fact that wages are now clearly going up faster than prices, and the fact that the unemployment rate has been at or below 4% for 25 consecutive months, which is the longest stretch of low unemployment at this level since the late 1960s. I think all of that is beginning to permeate the public mood, making people feel a little bit better, but certainly not satisfied or happy at this stage.
No, the social media doesn't seem to be changing. I think we'll always be grumpy a little bit because of that particular divide unless something changes in terms of their algorithms. But just tied to that then, the house prices, another source of one's happiness and sense of security. Mortgage rates, lowest transaction volume in US housing in 30 years, I think last year. In terms of maybe we can weave this into a longer section on interest rates, but where are mortgage rates heading? And more broadly, where are interest rates heading, especially after the Q4 GDP we just saw?
Well, let's table the housing discussion for the moment, because it really does depend on rates. So What the economy is doing is it's overperforming, punching above its weight in terms of growth, but the inflation track is very much on pace here. So we just got numbers on the PCE deflators for December, and they show that overall core inflation, now we're talking about 3% year over year. And if you look at the overall consumption deflator, including food and energy, we're down to 2.7% year over year. That's pretty much in line with the Fed's view as of December when they suddenly realized things are getting better. But we also saw 3.1% year over year GDP growth in the fourth quarter. And that's well above what the Fed thought the economy was capable of doing. And that's really been the story of the American economy. We seem to be able to be strong in terms of growth, even as inflation cools. Now, what does that mean for the Fed? What I think it means for the Fed is they're going to take their sweet time. Unless this economy gets into recession, they will cut rates this year, but they're going to do it, I think, cautiously and slowly, because they're going to be worried, I don't think correctly, but they will be worried that inflation is going to reassert itself. So I don't expect to see a rate cut, certainly at their January meeting. I don't think we'll have a rate cut. I think we won't have a rate cut in March either. I think what we might get is if the economy keeps growing, maybe we get June, September, December, get 3 rate cuts. So I think that's the most likely scenario if the economy avoids recession here. It might help bring long rates down a little. But remember, we've also got an enormous amount of government debt being issued. And the Federal Reserve, of course, is now selling government debt or allowing it mature, not buying in again. So that's adding to the debt in the markets. There's a lot of money for the Treasury to raise. And that does limit, I think, any further declines in long-term interest rates until we see a recession, which, of course, we don't want to hasten that day. But until we see a recession, I don't expect to see much of a rally in the bond market.
Not much relief on the mortgage rate side, but probably housing does need to move, given you can't have that there will be pent up demand. We probably were likely to see a little bit of shifting perhaps after the transaction volume of last year.
Well, first of all, the volume is very low. And you can, of course, you can see it. If you're a younger person, you're sitting in a house, you're thinking of moving. So, there's this nice job in Denver, but I've got a house in Chicago. How are you going to sell one house and buy the other? Because the house that you got in Chicago, you got a 3% mortgage on. The house you'd have to buy in Denver, you're going to have to pay 6% mortgage on it. 3% you can do, 6% you can't. And so the fact that so many people have locked into these very valuable long-term mortgages, starting with a 3, is basically freezing the whole market. And that, I think, is keeping supply extraordinarily low in the purchase market for housing. And I don't think that's going to change. It's just frozen. But what we are seeing is a lot of multifamily supply. In fact, if you look at multifamily units under construction, in recent months, that's been touching 1 million units under construction. And that is the highest number we've seen since the 1970s. So there's a lot of multifamily projects, and that could help alleviate the rent issue. And so I do think the rents will go up more slowly than overall inflation going forward, which is certainly much needed. And I think that will bring some more balance back to the market. But it's going to be a long time before we have a balanced housing market because of just all these old fixed rate mortgages, which nobody wants to get rid of.
On the volatility point, though, given what we've just seen in bond prices and the moving around, do you think more fixed income volatility is here to stay based on what we've seen over the last few months?
It might be. I mean, it does seem that for a given amount of macroeconomic noise, this would actually make for a very interesting chart. But if you put on one side the amount of volatility in economic growth and inflation, you put on the other side the amount of volatility in long-term bond yields, it does seem like this is one hyperactive bond market. I think it needs to be put on some medication to just quiet it down a bit. It does seem very volatile. That may have to do with changes in market structure in recent decades, which just makes the bond market more volatile and a little trickier for people who are trying to trade the bond market. I don't think it has huge implications for long-term investors, though, because a lot of this short-term noise really is that. It sort of bounces up, bounces back down again. So I don't think people should be too worried about it.
And meanwhile, equity markets seem to be quite subdued in terms of their volatility and to have the same patterns repeating over and over in terms of the Magnificent Seven, the prevalence of large cap and the underperformance small cap, mid cap, as well as non-US. Any thoughts on that and whether anything's poised to change there?
Well, no, I think markets will continue to grow to an extreme until some piece of drama occurs. So certainly we've seen market leadership from those big mega cap tech companies. They are generating a lot of cash, but the relative valuations do look high. But I don't see anything to particularly change that in the short run. Eventually we'll have a market correction. I do not know the day nor the hour. But when we do, it's going to be very important for people to know what they own. And so I do think people should pay attention to valuations domestically and around the world. and there is a big dispersion in valuations. But while the market, if the economy continues to grow slow, at a healthy, solid pace, if inflation continues to track down, if the Fed sort of takes their time by cutting rates, if all of that happens, then I expect more investor money will continue to plow into the indices and into these biggest companies. So I don't really see a short-term change in this, but as an investor, I would want to lean against that because sooner or later, that valuation dispersion is going to collapse again.
And how about something like small caps? There seem to be articles every few months just clamoring for a reversion to the mean or for them to be rediscovered. And clearly, they haven't been particularly popular compared to large caps. Do you think anyone would ever want to own small caps again? Do they have a role in the portfolio?
Well, to every asset class, there is a season. And the problem is that the season for small caps is usually just after a recession has occurred, when you look through the rubble and see what survived. And then they tend to be very cheap, and then you can buy real bargains. But people have been waiting for that recession. That recession hasn't occurred. And I think that's sort of holding off people getting invested in small caps. It's also true that a lot of small cap companies aren't actually making a profit. And I think in the post-pandemic environment, a lot of people are somewhat skeptical about, do I really want to invest in? Is this business model even going to work? And then finally, we've got a lot of regional banks in that area, and the problems the regional banks had, a year ago. And to the extent that they've got a lot of real estate on their portfolios or commercial real estate in their portfolios, that could also induce a certain degree of skepticism. So I can understand why people are skeptical about small caps. I'd want to have them in a portfolio because they are cheap, but I can understand why people don't necessarily think this is the moment in which small caps will outperform.
I have three topics to cycle through, and we'll go for the quick fire 1 minute each. And they are Bitcoin, emerging markets, and elections and geopolitics. I think we'll get the Bitcoin over with first because it's probably a pretty quick answer, I'm sure there. Bitcoin ETFs, a lot of fanfare. Does that change mean anything in terms of risk appetite for markets for digital assets?
It's just a new suit of clothes for a naked emperor. It's nonsense. Bitcoin itself is worth nothing. It is a focus of speculation. Cryptography is fascinating. And if you put it all in ETF, you've got another layer of fascinating on top of a layer of fascinating, all surrounding an empty box. If you ever want to know why people believe markets are illogical or irrational or not priced perfectly, look at Bitcoin. But I would never put any of my money or long-term investors' money in Bitcoin because it is nonsense. It's not worth anything.
Well, let's go to another volatile topic, emerging markets. So it seems like until we're blue in the face, we've been talking about emerging markets under one category, and yet we see markedly divergent fortunes looking at Japan. Well, Japan not being emerging, but Japan and India hit new highs, and China kind of try to resuscitate things there this week. Is it you on that, and should we just be binning the term, and is it up to JP Morgan now to come up with some new acronyms for our easy use?
I think it's a place where you do want to be an active manager, whether you have an emerging markets fund in general, but I think you should have an active manager and one who's willing to make bets actively. Chinese stocks are very cheap, but the real question is Xi Jinping going to do those things which restore confidence, consumer confidence, confidence in government, confidence within the world on the stability of Chinese policy? That's what China's lacking right now. It's got a lot of economic problems, but the center of them is consumers are scared, they won't spend, and that's slowing China's economy down. It leaves them without a growth engine. But outside of that, there's plenty of opportunity. Labor is scarce all over the developed world. The US dollar is too high. There's plenty of potential in emerging markets in Southeast Asia and Latin America and India. I think there's plenty of potential, and I'd want to have a chip on that square. I think people should not be zero weighting the EM area just because of Chinese problems.
And last question, I forgot to ask about elections. How could I have forgotten in an election year? But we did talk about some of that divisiveness that's been obviously so now for many years. We're not coming closer to a center. We've also seen some pretty interesting geopolitical shocks in the last few months alone. Impact on markets as the election year unfolds. Do you look to history for this, or is every year sort of standalone in terms of how it affects markets?
Well, a bit of both. I mean, I think the first thing is there is a lesson from history. It's a very clear lesson, which is do not let how you feel about politics overrule how you think about investing. Whether we've had straight Republican government, straight Democratic government, or divided government, I mean, each of those types of regimes, on average, the stock market's gone up and the economy has grown. And if you boycott markets just because the party you like is not in power, you tend to lose out. So I think that is true. But I think, we also need to keep an eye on it. I think people are fairly dissatisfied with the two candidates who are almost certain to be running at this stage, barring some health event. And I think it's contributing to the sort of sense of worry and gloom and caution in the country. But I still think that on average, the US economy has never flourished because of wisdom emanating out of Washington. It's really all about the private sector. It's about 330 million people who want to buy more stuff, want to work more hours, and want to get ahead. And so I would underweight elections and politics in terms of my investment decisions, look much more closely at the US economy, the global economy.
And it seems the same for geopolitical shocks as well. They don't have lasting effects.
That's right. You've got to distinguish between the horrific things you see happening to people around the world. And it is heartbreaking to see what's happened in Ukraine and in Gaza and in Israel. But you've got to distinguish between that and, well, what does it actually do to the global economy? Do people get up and have to work and have to make money and have to make a profit? And if the answer is it doesn't slow the global economy down, then the answer probably is it doesn't hurt the stock market.
Well, thank you so much, David. Thank you for your generosity and sharing your thoughts with us. Good luck in Boston. We'll get you back, I hope, after the Boston Marathon and closer to the election to revisit some of these themes.
Looking very much forward to it. I'm running Boston again for Dana-Farber, but this time I get to run it with my two sons, which is going to be very special.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.